Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is July 28th, 2025. I am Luna.
I am JPMorgan.
Into what's really moving the needle. U.S. stocks, they've been on this incredible tear, hitting record highs. But, under the hood, there are some big macro shifts and policy debates brewing that we absolutely need to unpack. All right, so let's get into it. Where did the market leave off? U.S. stocks just kept climbing at the end of last week. The S&P 500 ticked up 0.4% to 6,389. That's its fifth record close in a row. And the Nasdaq added 0.2% to 21,108, another record. The Dow Jones climbed 0.5% to 44,902. Now, the story seems to be optimism, right? Trade talks, strong earnings. But what about other assets? Same picture.
It's interesting that strength was pretty broad. You saw gold near $2,050 an ounce, up 0.5%. Bitcoin traded around $119,500, gaining about 1% in 24 hours. Even crude oil, WTI, it edged up to about $75 a barrel. So yeah, risk assets generally positive. And this is where it gets really interesting. Look at the 10-year U.S. Treasury yield. It jumped. It's sitting around 4.4%, its highest in months. It even briefly touched 4.51% during the day. That's the highest we've seen since, late 2023.
Wow, 4.51% intraday.
Exactly. And that surge, it really highlights growing worries in the bond market about inflation and about the deficit picture. Big concerns there.
Okay, so those are the numbers, but let's connect them to the why.
Right.
What major events in the last, say, 24 hours are driving these moves? What's the bigger picture?
Well, the main event has to be the U.S. and EU tariff agreement. It basically stopped a potential trade war from escalating. The U.S. landed on a 15% tariff for most EU imports. That's, way lower than the 30% that was being threatened.
15% instead of 30, still a tariff, but less severe.
Right. And in return, the EU has committed hundreds of billions in U.S. investments, like $600 billion plus energy purchases, about $750 billion worth. And key sectors like aircraft, chips, pharma, some agriculture, they're exempt.
So some relief initially.
Yeah, the market breathed sigh of relief at first. But then attention quickly turned to, okay, what does even a 15% tariff mean for inflation?
And that inflation angle seems directly linked to the next big thing, those surging yields you mentioned, right?
Exactly. It all ties together. That new trade deal plus ongoing government spending, it just fanned the flames of inflation and deficit fears. So investors started selling off treasuries, and that's what pushed the 10-year yield up past 4.5% intraday.
So the bond market's basically saying, hold on, these policies might push prices higher.
Precisely. It reflects concern that tariffs and heavy spending could boost inflation, eroding bond values, and of course, higher long-term rates can squeeze those high-growth stocks.
Makes sense. Now, let's shift gears slightly. There's been some pretty public pressure on the Federal Reserve lately.
Oh, absolutely. The White House has been quite vocal, pushing the Fed for rate cuts. You had Russell Vought, the budget director, publicly criticizing Chair Powell for being too slow. He even questioned the Fed's renovation costs, believe it or not.
Renovation costs. Yeah.
Yep. And then President Trump called for the Fed to slash rates down to around 1%. The current range is, 4.25, 4.50%. He even visited Fed HQ last week.
That's direct.
It is. And it raises, serious questions about Fed independence, especially because Fed officials are signaling caution. They're citing inflation risks, the new tariff effects. It's a tricky spot for them.
Definitely a delicate balance.
Yeah.
Okay, looking ahead then, what are the key economic reports you'll be watching this week? What should listeners keep an eye on?
It's a busy week. Wednesday, July 30th, we have the Fed meeting conclusion. The expectation is they'll hold rates steady. But Powell's press conference, that's going to be watched very closely for signals, given all this political pressure and the new trade risks.
Right. Powell's tone will be key. Mm-hmm. What else?
Thursday, July 31st, we get the first look at Q2 GDP. Analysts are forecasting maybe around 2.5% growth. Then Friday, August 1st is a doubleheader. We get June PCE inflation data. That's the Fed's preferred measure. So an unexpected jump could reinforce a more hawkish stance. If it cools, maybe it helps the case for cuts later.
And the second report on Friday.
The July jobs report. Non-farm payrolls and unemployment. The consensus seems to be predicting a slowdown, maybe around 100,000 new jobs, and a slight tick up in unemployment. That could definitely sway Fed thinking too.
Okay, so let's tie it all together. For you, the investor, looking at the market outlook, what are the main takeaways, the key risks?
Look, the U.S. stock market is starting the week strong, no doubt. But it's facing a real gauntlet of challenges. The trade deal removed one immediate risk, yes, but the new 15% tariff, it brings its own uncertainties. Potential impacts on prices, supply chains, company profits. It could keep inflation sticky.
So more potential volatility ahead.
I'd expect it, especially with the Fed meeting and all this major data coming out. And a key risk remains those treasury yields. If they stay elevated near these multi-year highs or climb further, that could really weigh on stock valuations. Add in the political noise around the Fed, maybe more tariff reviews coming in August. The margin for error feels pretty thin with indices already at record levels.
Well, summing up, the general picture looks okay. Decent growth, earnings are holding up, less trade tension for now. But these short-term risks, inflation, rising rates, policy surprises mean you need to be cautious. This deep dive really shows a market juggling these big policy changes and economic numbers, just trying to stay upright. It's quite the balancing act. So as you navigate the next few days, here's something to think about. With the market at these record highs, despite all this policy back and forth, how much of this rally is built on solid ground versus just, optimism that could evaporate quickly?
Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver days key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.